Hi, and welcome back to another episode of The Mortgage Musketeer, where today we're going to be talking about conforming conventional loans. And what does that mean? What do they encompass? I'm going to break down mortgage insurance, down payments, everything that you need to know about conforming conventional loans. So let's get started. Okay, so the biggest thing about conforming conventional loans is understand that this is kind of like the foundational aspect of getting a loan. It's what banks and brokers and lenders, this is your standard loan. Your government loans kind of help and supplement and back up your conforming conventional loans. So what are the standards of conforming conventional loans? And when we're talking about that, really what we're going to be focused upon is credit score, your loan to value, debt to income ratio. Alright, so in some aspects, a conforming conventional loan is more stringent, and in other aspects, it's a little bit more forgiving. So what I mean by that is, if you are a better qualified buyer, then there are other aspects where they're going to relax some of the requirements that government loans have. So let's focus on conforming conventional loans. First of all, let's talk about your credit score. Now, technically, you can take it down to a 620 credit score. But if you do that, you're going to be, first of all, it's going to be more difficult to get an approval on that. You're going to have some mitigating factors, like a lot of assets, a lot of money in the bank or investments or something like that. And your credit profile, whatever's impacting your score to bring it down to a 620, can't have a lot of layered risk that the automatic underwriting system is going to pick up. Only way to know that is to run it, okay? Run it for your loan officer to run it through the automatic underwriting system. But if you can get an approval, you're going to get beat up on the interest rate because you're all the way down to a 620. Now, kind of the sweet spot where you see this transition between government loans, and particularly FHA, government loans and your conventional, is around a 680. And understand that the credit scores and pricing tends to go in 20-point buckets. So once you reach a 680, you have about a 680 to 700 where, you know, it's kind of hit and miss. And once you get into a 700, then you're solidly into the conventional range. So if you are hovering around 680, you may find yourself with a better loan on the FHA side. But again, every individual is different and you got to run it. But just from a kind of like a transition standpoint, thinking about a 680 or above, all right, for a credit score, that's when you're going to be thinking about that you're getting in a conventional range. Again, you can do it lower, and there are instances where having a lower credit score and still taking a conventional are beneficial. For instance, with an appraisal. All right, so we've talked about in the past where government loans have an inspection component to the appraisal. Conventional loans do not. So it makes it a little easier to purchase foreclosures or houses that may not be in tip-top shape with a conventional loan, whereas it may not pass an FHA, USDA, or VA appraisal inspection. There's no inspection component to a conventional appraisal. So that could be an instance where, even though you may qualify for a different kind of loan, it may be beneficial to go conventional because it's a little bit more forgiving on that appraisal. That aside, you're probably going to be wanting to have a higher credit score to qualify for a conforming conventional loan. The other aspect is your debt to income ratio. Now, technically, to fit into the conforming conventional aspect, you top out at a 43% debt to income ratio, but there's currently a patch in place to take you up to a 49%, anything below a 50% debt to income ratio. So if you're in the 49% range, technically you could get approved, but your loan officer needs to run it. If you have a high debt to income ratio and your loan officer says, oh yeah, you're good, but they haven't run it through the automatic underwriting system, can't trust it. You know, especially once you get above 45%, then you have to run that, and you have to have some additional assets in order to offset the layered risk that higher debt to income ratio is going to create. Now, can you get up to 49%? Yes, you can. All right, so just know that 43% is really where the cap is, but there's currently a patch in place that allows us to go up to 49%, and that's dealing with Congress. And if they were just dealing with that not too long ago, where that patch can run out, and if it runs out, you're going to have that cap sitting at the conforming guidelines at 43%. Now, they know that and they continue to update it, but just keep that in mind that it needs to be run through the automatic underwriting system to ensure that you have an approval. All right, then we come into loan to value, and that kind of corresponds with your down payment. So, what is your down payment? And that's a big question that we get. How much do you actually need? Most people think along the lines of 20%, but 20% really involves mortgage insurance, and I'll expound upon that in a second. As far as your down payment, you can put down as little as 3%. Normally you're looking at 5%. There's really two instances where you can go down to 3%. First of all, there are programs called Home Ready and Home Possible. Home Ready is for Fannie Mae, Home Possible is for Freddie Mac, and those allow, and oftentimes it's first-time home buyers, and it does not have to be, but it allows people to get into a home with 3% down. It's a pretty good deal. It has reduced mortgage insurance, good rates, for only putting 3% down. There's a little bit more risk involved in that. Now, the key to that is there is an income cap. And those income caps have actually tightened up, and you can only make about 80% of the median income in the area, in the county. And your loan officer can look up what that is. Harder to qualify for because that income cap. If you don't qualify for the income cap, there is still a 3% down program for conventional, but you're going to get crushed on the interest rate and crushed on the mortgage insurance, because mortgage insurance is a lot of times risk-based, okay? And if you're only putting 3% down, you only have 3% skin in the game, that's going to increase your risk to a lender if you default on that loan. If you go into, especially now, during the whole coronavirus thing, if you go into forbearance, or if for whatever reason you go into foreclosure, not making that payment, there's not a lot of equity in that home. You as a buyer, if you only put 3% down, do not have as much skin in the game. So the corresponding mortgage insurance, and mortgage insurance is designed to protect the lender in case you default. Well, if you put less down, then your mortgage insurance is going to be higher. So you could have a higher payment by putting less down. So it will oftentimes be more beneficial to get to the 5% down payment. Now, anywhere between 5% and 20% down, you're going to have mortgage insurance. But this should, just explaining this, dispel the whole concept that you got to have 20% down to buy a home. You do not. As I mentioned, you can put as little as 3% down. A lot of people will put 5% down because they want to put the least amount down, but they also don't want to get beat up on the mortgage insurance. So 5% happens to be, where a lot of people who want to get into a conventional loan just happen to get if they qualify for it. So you do see it, but it's anywhere between 5% to 20%. The majority of people are either putting 5% down or they're putting 20% down to eliminate mortgage insurance. Once you put 20% down, the lender feels that you have enough skin in the game where you don't need mortgage insurance anymore. In other words, the risk factors are reduced enough where they won't require mortgage insurance on the home. So anywhere in between there, up to 20%, you're going to have mortgage insurance. Now, mortgage insurance, as I mentioned before, is risk-based. And what that means is that they're going to base your mortgage insurance upon your credit score, how much you're putting down, and your debt-to-income ratio. So there's a lot of factors that you got to plug into that for your mortgage insurance. And then they'll spit out a rate. There's multiple national mortgage insurance companies. Different lenders use different companies. There are even a couple lenders who have reduced mortgage insurance. So you might want to, and that's where brokers are handy, because we can shop around and figure out who to take you to, and reduced mortgage insurance might be something that will help your debt-to-income ratio to actually get you into a conventional mortgage. So there's a lot of factors that kind of go into this. So understand that mortgage insurance, once you reach an 80% loan to value, mortgage insurance will go away. So for those people who are thinking that they have to save up 20% in order to have a down payment, you really need to think about that, because how long did it take you to actually get 5% down? And then how much longer would it take you to get 20% down? Because what I hear all the time is, I don't want mortgage insurance. Well, mortgage insurance is not inherently evil. And mortgage insurance, depending on where your credit score is, etc., and how much you're putting down, may not be that much. All right, so what you need to think about is getting into the home. Because if you're paying rent, you're just throwing your money away versus just taking your 5% down, 3 or 5% down, getting into the home, paying mortgage insurance, and understand that is loan to value. Mortgage insurance is based on the loan to value. So let's say that you get into a home today where you're putting 5% down based on the sales price, but you're in a market where the houses are appreciating. So in a couple of years, your house may appreciate to the point where you can actually refinance and get out of your mortgage insurance, because it's about the value, not the purchase price, but the value, especially if you get a good deal. If you get a good deal on a home, and then you know that there's going to be equity out there, you could be reaching that 20% loan to value far earlier than it would ever take you to save up 20% to put down. And you're not throwing away your money at somebody else's mortgage if you're renting. So think smart about that. Don't be so adamant that you don't want mortgage insurance that you're afraid to make the commitment to purchase a home, because it doesn't make financial sense. All right, talk to your loan officer. They can break down the numbers and they can actually show you the benefit of buying a home with mortgage insurance. Okay? All right, so we talked about several different aspects of a conforming conventional, and just understand that it is the primary loan that the government and that bankers and lenders are looking for, is to get you into a conventional loan. That does not mean that the government-backed loans are lesser in any regard, because just like I talked about with the mortgage insurance, the idea is getting you into home ownership, and that's what government loans are for. So don't poo-poo government loans hoping to get a conventional loan, because you're going to need to get into the home, and then you can improve your circumstances and perhaps refinance into a conventional mortgage. All right, conventional mortgages, because you tend to have a higher credit score and they're more stringent, you gotta have a lower debt to income ratio, gotta have a higher credit score, they tend to be more forgiving on other aspects. For instance, they have some pretty cool items with your student loans, and here's a link to the different aspects of buying a home with a student loan. But what you're going to be thinking about is with Freddie Mac, they'll only take 0.5% instead of 4% if your loans are deferred. If they're income-based repayment plan, you can use whatever is actually there, as opposed to a government loan where they're going to take 1%. So there's a bunch of other factors where they can kind of be a little less stringent, and basically they're rewarding you for having a good credit score and a good debt to income ratio. All right, I hope this was helpful. If you have any additional questions, leave them in the links below, and I will break down anything that you think I may have missed. And please, if this was helpful, subscribe to the channel, and I look forward to seeing you in the next episode. It's all for one, and one for all.